Today is 2022, the year when stuff starts to break. Hello again, it's Martin North from Digital Finance Analytics. Well, there is post covering finance and property news with a distinctively Australian flavour. Today, I'm joined again by Tarric Brooker. Hi, Tarric.
G'day, Martin. How are you?
Yeah, not too bad. Things keep falling apart.
Well, first it was, the Turkey and the Turkish lira, and then it was Chinese property, and now it seems like it's gone full circle and we're back, with things starting to fall apart in the US. At least that's the way it looks at the time of this recording.
Well, certainly, if you look at the moving averages, the markets are significantly down. I think that finally people are realizing that interest rates are likely to go up. And that's creating all sorts of contentions. And by the way, the jobless numbers went the wrong way as well today, didn't they?
Yeah, I'm assuming you're referring to the US ones. Yeah, they didn't look the initial jobless claims did not look fantastic, and they're pointing to an actual decline in employment in January at this point. So, we're just gonna have to wait and see in that regard. Omicron may well rain on the parade somewhat, although perhaps that's what some investors sort of want to see at this point, because it might mean the Fed might hold off a little bit longer on raising interest rates.
Well, the old question then does come up, doesn't it? Is the cavalry in the form of the Fed coming over the hill with yet more largesse?
Well, Jim Bianco asked that question on Twitter. I think it was late last night or early this morning, and he made a really interesting point that basically the Fed has two choices. They can either let inflation get out of control and save the market, or they can basically do their job and address the issues with inflation. And he made the point that 40% of Americans have less than $1,000 in savings. So, well, that's accessible at call savings, I should clarify. But that is a startling figure. It basically means that there is no room left for the average person, for these lower income households, to be able to afford these inflated prices without cutting back their spending. And we're seeing that in retail sales, and we're seeing that in consumer confidence in the US.
Yeah, and some of the house price data and mortgage data that's just come out also is looking a bit wobbly because, of course, mortgage rates are going up in the US too.
They are indeed. I mean, according to some sources, the US mortgage rates have already gone up over 1%. From where they were a little over, I think it was about roughly almost exactly a year ago. So we haven't seen US housing prices start to slow down in a huge way just yet, but it really does make you wonder how much longer this can last once these pandemic-driven effects start to fade away.
Exactly right. And Jeremy Grantham came out today, the guy who's been in the markets for a long, long time, saying the bubbles, they're about to go.
Well, I think one of the things that was interesting about what Grantham said was one thing that I thought was fascinating is he's talking about a 50% drop, yet a 50% drop in the S&P 500 doesn't even get us back to where we were last March. No, sorry, not last March, March 2020, which is interesting. But also that he said that not even Fed intervention could save the market this time, and that's a big call considering how they've come to the rescue in the recent past.
Well, that's why I mentioned it, because, if the concept of the cavalry coming over the hill, Grantham saying, well, they might come over the hill, but they may not come with a huge amount this time, and it may be not enough. And maybe this is the time when the markets finally turn turtle. But I guess we'll we'll wait and see. Like we said, really interesting times. Now, you've put, of course, your normal charts together, so maybe we should go a charting. What do you think?
Yeah, sounds good to me, mate.
Okay, well, there you go. Feel free to lead off.
All right, well, we've got the nice little cartoon from investing.com, as we do pretty much every week. And it's basically yields getting away from Jerome Powell, which is exactly what's happening to the market at the moment.
Yeah, that's a very cute cartoon, isn't it? Eh?
I love their cartoonists. They're fantastic. If I ever get big on YouTube or on social media, that dude's making my t-shirts.
I love it.
Okay, now German producer prices, basically they are just off the charts. The even if you go all the way back to the beginning of this indices when they first started putting them together in post-war Germany in 1949, there isn't anything that gets to this level of producer price inflation. I think you could probably say that this is the highest level of producer price inflation since either the very end of World War II or the immediate aftermath and the shortages that resulted from, the wholesale destruction of Germany. And the fact that the ECB continues to sit on its hands as this happens really speaks volumes. I mean, even if only a fifth of this ends up being in the German CPI next year, that should still be more than enough to, well, frankly, really make people's lives difficult and, in theory, force some form of action by the European Central Bank.
And interestingly, the Fed, is talking about interest rate rises, but the 10-year bond, actually went positive for the first time for a couple of years or so.
What a novel idea, isn't it? The idea that you should actually get paid something for your money when you lend it to the German government for a decade.
Very novel.
Okay, now this is one that I think is actually really fascinating and is going to be absolutely key to the US inflation story and to markets in the months ahead. It basically shows that Atlanta Fed's wage growth tracker is at its highest level since 2002. So it's highest level in 20 years. And last time, wage growth pressures got anywhere near this high, it took the global financial crisis to put downward pressure on them. Not even the interest rate hikes of 2008 really brought wage growth pressures down. So if this is the beginning of another significant wage growth cycle in the US, interest rate hikes, even the potential of a recession may not be enough to put downward pressure on that particular driver of inflation, which could really create some problems and some interesting scenarios, because it's entirely possible that because inflation has gotten so far ahead of wages in the last 18 months, you could see a scenario where wage growth pressures remain strong, even if you're on the cusp or just in a recession, which could really create some interesting problems for the market and for the Fed.
Yeah, and 2 points there. The first is that if you look at where the wage price growth is strongest, it's not uniformly spread across all workers or all industries, right? First point. Second point is that with the inflation rate where it is, the net is that people are still going backwards.
Yep, exactly right. And that's part of the issue as well, because it's all well and good for the Fed or for the Bureau of Labor Statistics or whoever to say inflation is X or Y. But when people are seeing their rents rise by, and these are actual numbers, this is not just stuff I'm pulling out of my butt, whether it's Zillow, Apartment List, or any number of other independent providers of rental price data, they're seeing rental prices up somewhere between 12 and 17%. While while the Bureau of Labor Statistics says 4%. So that is what their wage demands are going to be driven by. They don't care what the CPI says. They care about the inflation that they are experiencing, and that is going to be one of the really key things this year. Because even if the CPI does come off the boil, people are still feeling these pressures in a much more profound way.
Absolutely, and of course it's worth remembering that the rental statistics that feed into the CPI is delayed somewhere between 6 months and 12 months.
Yeah, so and there's also the fact that a large proportion is estimated by homeowners because reasons.
Yeah. So those are really good numbers, aren't they?
Yeah. Oh, they're great if you want to underestimate rental price inflation. Okay, now this is I think a really interesting one because it shows the breakdown of the US CPI. Now, while obviously goods are one of the main drivers of inflation in this current time, along with energy, it shows that services inflation hasn't really taken off yet. Services inflation is roughly where, not too far from where it was prior to the pandemic starting. So, late 2019 numbers. So if we do start to see services inflation pick up in the next few US CPI prints, even if goods inflation starts to come down, if you start to see good services inflation get to the point where it's pushing up towards, high twos and even into 3% as a component of the CPI, that in and of itself is going to be enough to keep the Fed on the path of more hikes. I mean, we are going to see some base effects, and that's going to distort the picture somewhat. But I think that services inflation is something that the Fed is going to be really, really concerned about in the next 6 to 12 months.
And one point there is that services, many areas of services, there is more latitude for businesses to lift prices for services relative to goods. Sometimes the competition is less. Sometimes the specific services are quite unusual, and therefore there isn't a huge amount of competitors there. So often, once the services side of the equation starts roaring away, that really does put further upward pressure on inflation.
Yeah, exactly. And that is the type of 1970s-esque feedback loop that they're really concerned about. And that's equally true of the rental side of things and of the wage growth side of things. So I think those are going to be some of the key factors the Fed is going to be watching. So even if the CPI comes in a little bit lower than expected, and the market sort of takes a bit of a victory lap, provided it's not on its knees at the time, I think that could still keep some fairly significant upward pressure on interest rates.
And it's worth noting that Bostic, one of the the Fed chairs, was very strong on they need to do more and they need to do it quickly to be able to tackle this. And it almost like they continue to talk it up rather than talk it down.
Well, I think we are seeing a lot of jawboning, a lot of let's see how much the old microphone can do before we start unleashing the hammer of rate hikes. But I don't think that jawboning is realistically going to be enough this time.
No. And of course, next week we'll hear.
Yeah, indeed. And next week we'll have Australia's CPI data for the fourth quarter of last year, because having a lag on that's that long is just a fantastic thing to have in a $2 trillion economy. Okay, this is an interesting one, because consumer confidence is normally linked to basically the conditions experienced by consumers. How much are they making? What do their wage growth look like? What does the cost of living look like, etc. And normally the level of inflation is not really a huge concern, or at least it hasn't been in the years since the financial crisis, mostly because inflation has been relatively subdued, at least according to the official numbers. But this time it's different. This time inflation is dragging horribly on US consumers. In terms of current conditions, they now see things that things are worse now than they were when we first went into lockdown, when the markets went down the toilet and everyone was panicking and didn't know what was going to happen with the pandemic. And that is an absolutely crazy, crazy number. And it really shows how inflation is becoming a real headwind for US consumers and the broader US economy.
And interestingly, the Michigan survey also had a similar finding, didn't it? It was pretty off as well in terms of future expectations of inflation very high, levels of confidence easing back. And by the way, true here as well. My latest survey data is showing that consumers are getting much more twitchy, and it is partly linked to the inflationary pressures and cost of living, plus the general levels of uncertainty.
Well, it's interesting you mentioned that, because we're seeing similar data in the ANZ data, because they came out recently with their weekly consumer confidence report, and that suggests that inflation expectations are becoming entrenched around about 5%, which is quite high by that index's history in recent years. And I think we could see some fairly significant inflationary pressures. I mean, I've heard from people from industries from A to Z, and they're talking about these double digit rises in costs. So although how it all ends up getting measured at the end of the day is obviously a completely different story.
Well, measuring it is, of course, absolutely completely off the scale compared with where things are for many people. But it is interesting that if you look at the price of oil, still going higher. And one of the interesting observations this week were hedge funds are barreling, quote, into oil, because that's basically the only thing that's going up at the minute.
Well, that's one of the real risks in all of this, because one of the interesting things that I read in an oil industry report recently was basically oil discoveries, as in new oil fields that have been discovered in 2021, was at the lowest level since 1946. Now, while obviously the world wants to transition to electric cars and all these other different things relatively soon, the oil, I don't think that we are going to be able to shift as quickly as a lot of people believe, and that could keep demand for oil higher for longer, and that could really create some problems because the exploration isn't there, and basically a lot of people are pulling back at the moment. So it could really get interesting in terms of the oil price over the next decade.
Well, I saw some research suggesting, $100 a US barrel, easy, and it could go a lot higher than that. Now, that quantum, and remember that 2 years ago there were negative oil prices, right? I mean, that quantum will have a very significant impact, as you say. And then there's the question of how much supply is there? Is Russia playing silly bees or not? Is there more supply in the system or not? And of course, the recent terrorist activity in the Middle East isn't helping either. So the supply side is looking a bit wobbly.
Indeed, and I mean, unless the sort of the Russia-Ukraine situation goes kinetic at some point, those tensions are not going to go away anytime soon. So that could be potentially a contributing factor to keeping oil prices higher than otherwise for longer.
Absolutely, very interesting.
Okay, now this one is quite a fascinating one because it shows the same thing as the US consumer confidence surveys, because it shows that in inflation adjusted terms, US retail sales have gone backwards fairly significantly since April, which is when the last stimulus checks got sent through, and it really speaks to the issues that the Fed now has, because under more normal circumstances it would be like, oh, retail sales are down. That's bad. I mean, as you can see on the right there, even the core number, which strips out some of the more volatile elements, fell by 2.3% when the expectation was for a small rise. Now, under more normal circumstances, the Fed would be hitting the panic button, going, we should cut rates, or we should whatever tapering, whatever tightening of monetary policy we want to engage in, we should probably rethink that. But because this is being driven by inflation, because consumers are tightening their belt, falling retail sales are now bullish for rate hikes rather than bearish. And I think that's a really important distinction that's evolved just in the last 4 to 6 weeks.
Now, that is very interesting. And, there's no doubt that retail and consumer sentiment is very, very tightly linked. There are two areas, of course. There's the confidence side of it, and then there is just simply the available cash, right? So if effectively your available cash is more limited, you're having to spend money on other things, the basics, if you can find them, that is going to have a significant impact. And of course, the US economy is so reliant on the consumer. It's something like 2/3, isn't it, of economic activity is consumer related in the US. It's massive.
Absolutely, and that really is the risk going forward, because the question is can you run an economy on the spending of the wealthy, on record Rolls-Royce sales, on record private jet travel, on record super yacht purchases? And the answer so far, looking at these numbers, is no. So I think that's going to be an issue that the US is facing now. And I think as the Aussie economy slows and as we face inflationary pressures, that could be something that we're going to have to look at ourselves in the coming year.
I agree with that. And, you can't rely on a small sector, rich sector maybe it is, to drive the whole economy. That's just not going to work. And that's the problem, of course, with particularly in Australia, with it so narrowly based.
Absolutely. And I will get to that in one of the slides in just a few minutes. Now, this is the US fiscal cliff, basically showing how the how the stimulus is fading away. But one thing I think is important to keep in mind is that even in Q4, in terms of the percentage of GDP being thrown at the economy, it's still roughly the same. Even in Q4 2022, I should say, not Q4 2021, it's still roughly the same amount as Obama was throwing at the US economy during the absolute height of the US GFC stimulus response. So it really just goes to show how much of what we're seeing at the moment is really quite artificial, and that basically there's going to be taken about 2.5% of GDP out of the economy this year. So, whether the US economy can take 2.5%, without economic multipliers and everything else being taken out of it, is quite an important question. And I think there's implications there for inflation, and there's implications there for basically pretty much everything from the market to what's going to be experienced by everyday households.
Well, that's very important to understand, right? Because there's, a lot of the talk has been about interest rates, but of course the Fed had been expanding their balance sheet dramatically. They're still expanding it now. They're talking about changing it later. But the conversation about what the Congress has done with all that stimulus money, which is still flowing through, is not really on the agenda of many people. They don't get it. They don't understand just how big that is. And by the way, of course, in Australia, the amount of stimulus that was flowing through was even bigger as a proportion of GDP, the movement, as it were, than in the US.
Indeed, and I think it's also just on the topic of interest rates, the US doesn't have the same problem as Australia. If rates rise, mortgage rate, the repayments on an everyday mortgage doesn't go up. They've got their, something like 90% of new loans that are written for 30 years, or the remainder of a 30-year loan at that fixed rate. So it's not like Australia. Interest rates can go up, and it's like, oh, well, whoop-de-doo. Okay, you're going to pay a little bit more on your credit card, car loan, student loans, etc. But it's a much, much lower proportion of overall debt exposed to rising rates. And to be completely honest, everyone talks about the impact of rising rates and all that stuff and how it's going to be like the end of the world. And don't get me wrong, it's going to do damage, but it's going to do damage for psychological reasons and to over leverage households. But in terms of the overall impact on the economy, say here in Australia, for example, a single rate hike is going to cost the economy somewhere around about $4.5 billion, not including the fact that they end up just not taking the lower rate. They just see the loan go down, and they just keep the repayments the same. So there's no real net benefit there. But say hypothetically you raise rates 0.25%. It costs the economy about $4.5 billion in terms of overall spending, but we're injecting $199 billion every year in terms of the deficit, in terms of equity mate home equity withdrawals. So, it's all and good for people to say, oh, but interest rate hikes are going to be devastating. It's like, well, if they're going to be devastating while we're injecting almost $200 billion a year, then the economy is broken and it deserves to be fixed. We shouldn't be trying to, keep this ship that's already, halfway underwater afloat. Just let the bloody thing sink. We'll salvage it. We'll fix it. We'll have a better time later.
Yeah, but it does make the point, isn't it, that all the fixation on interest rates is missing 80 to 85% of the story.
Yeah, absolutely. The stimulus is the story. You take away that, ScoMo decides tomorrow that, the only way that he can win the election is 100% balanced budget and slash and burn whatever. If they were to do that, the entire economy would basically go into a depression tomorrow. So, I think that's really something that people need to keep in mind when they go on about an undeniably strong economy.
Well, that's right. You know how much the undeniably strong economy costs. We're probably all up for $1 trillion or something in terms of total debt, right, to make it all happen.
Yeah, probably. And then there's all the fun and games with the RBA and the TFF and the QE, and we've only bought a larger proportion of all government of federal debt than the Fed has the entire time they've been doing QE. But what's that between friends?
Exactly right.
Now, this is what I was talking about earlier regarding the savings issue in the US, because as you can see there, savings aren't really being drawn down in a significant way. They're only being drawn down by somewhere, my estimation, of about $12 billion a month. And that's really not a whole lot in an economy that's worth over $20 trillion in a year. And technically speaking, looking at the fact that obviously inflation has taken off fairly significantly, savings rates today are actually significantly below where they were prior to the pandemic in terms of the amount of money that's being saved each month. And that's I think something interesting as well. And I should mention, I didn't have space to put this in, but US consumers borrowed more money from consumer credit, so this is credit cards, personal loans, etc., more money in December than they ever have before. $40 billion in a single month, yet retail sales are still going down the toilet. Yep. And I think that speaks volumes when you're injecting $50 billion in the form of savings and consumer credit, and retail sales are still going backwards. I think that speaks to people increasingly relying on these things to keep their households afloat and to keep their spending static in the face of inflation.
Yeah, and credit card debt in particular was very, very strong, wasn't it?
Indeed, it was, and that's something that's going to be really interesting to watch going forward in the US. And I think that's going to be something that even the Fed is going to be watching, because if people are, relying increasingly on credit cards, it speaks to a consumer that doesn't feel comfortable, and comfortable consumers are not spending consumers in the long run.
Exactly. Yep.
Okay, now this is a little bit about China. Now, China have cut rates twice in 2 weeks on their short-term loans, which has just been, hilarious, really. The 1 year prime rate has been cut by 20 basis points in the past 2 weeks, and it's fascinating to watch. And you're seeing Chinese retail sales growth well and truly rolling over into low single digits, and continuing to surprise to the downside. And this comes at a time that the latest data shows that Chinese housing starts are down a whopping 31%. Now, we obviously expect that will reverse somewhat, that things will improve in the new year on the sort of tinkering around the edges and the attempts to kickstart the industry by the Chinese government. But it really does speak to a sector that's in some fairly major difficulty, and I think it's going to take a lot more than a few little rate cuts to really save it.
Yeah, well, there was some interesting reportage this week that they were trying to find a way to allow developers to access some of the early deposits, because they're normally held in trust, as it were, so they're not accessible to the cash flow of the developers. So they're trying to work out whether there's a way of pulling that money back in to try and help some of the developers, because the developers can't raise more money.
It's really quite ironic, because the CCP and the People's Bank of China and the regulators spent years and years trying to stop all that stuff from happening.
Yep.
They spent years trying to rein in this excess, but now that the developers are lacking this liquidity, they're just looking for any stopgap that they possibly can. And I think at the end of the day, the key issue in all of this is that, one, is the demand there for Chinese housing? We're seeing, for example, in Shenzhen, rents have fallen significantly down to the same level as where they were in 2017. And also, if housing prices aren't rising, why in God's name would you go invest at something in something at up to 43 times household income? When your rental returns are paltry, it doesn't really make sense. So, they've really stuck between a rock and a hard place there.
Absolutely. And it's worth noting, of course, as you say, they've cut the interest rates. They've already reduced the capital ratios at the banks to try and give them more latitude to lend more. But of course, the older adage is you can allow people to lend more, but you need people who want to borrow. And in this environment, the question is, will people borrow, or will they prefer not to borrow because of the uncertainty question again?
Exactly. And speaking of borrowing, I think people are going to like this next one. This is the ASX's RBA rate tracker, which basically shows that we are seeing almost a full rate hike priced in for July next year, and almost 6 rate hikes. Sorry, July this year, I should say, and 6 rate hikes by very nearly 6 rate hikes, I should say, by May next year. So, I mean, I don't think that we're going to get 6 rate hikes over that period. I mean, don't get me wrong, it would be hilarious. But yeah, it'd be really something to watch. But I mean, part of me wonders if we're going to see something break in the markets before, like the title of this video. I think we're probably going to see something break in the markets, whether it's here in Australia or elsewhere, that's going to potentially put downward pressure on interest rates. However, I do wonder if we are going to see some form of entrenched inflation. Like while my base case is that something's going to break and something's going to go wrong, that's going to sort of put that bit of downward pressure on rates, I really do wonder we are going to see some permanent inflation flowing through in the US, and that could potentially keep upward pressure on Aussie rates for longer than any of us expect.
Well, it is interesting. Westpac now has basically come out and said, yeah, there will be probably a rate hike this year, right? And that was based on partly the employment numbers, which we mentioned earlier on, and also the very much stronger drive upwards in the US now. And most of the commentators are now saying, yeah, rates will definitely be higher. They're still a bit confused as to why it is the market is so aggressive with the rate hikes, and I'm not sure whether they will necessarily follow through, but it really does put huge pressure on the Reserve Bank when they meet next time, right, to try and actually work out what to do, right? On one hand, they've got COVID, and with all of the uncertainty about that, and the fact that we've got an unofficial lockdown in many eastern states, WA is still locked down forever, all of those things. And yet you've got this other sort of set of financial pressures, and specifically the issue of higher rates. And you've got employment down at the level that they didn't think they'd get till way later this year. So, the RBA is going to have to come to the party way sooner than many people expect.
Yeah, and I think that really goes to show that their narrative has failed and forward guidance has failed. They keep getting these things that they didn't expect, and rather than saying from the start that they were data dependent, which is frankly the way central banking should be done, they've gone off on these narratives and made all these promises that frankly, if things continue, they're not only not going to be able to keep, but people are going to be really, really pissed with them. I mean, if you've got say hypothetically you got a loan, right? You got a 3-year fixed loan in May of 2020. At 1.7%, right? And you come out and rates have risen 6 times, if this is correct, right? So you're going to go from a rate at 1.8% to a rate of somewhere around about a ballpark of about 4.5, 4.6, based on the RBA's current average variable rate. So your servicing costs of your loan are going to go up more than 100%. Overnight in terms of your interest cost. And a lot of people are going to be really pissed off about that.
Well, it is very interesting. Of course, I run sensitivities on households' finances and what rate rises they can stand. And, if you go up 1%, it's going to be quite painful for quite a few people. But if you go out more than that, it starts to get really quite serious. And, sure, some people are locked into fixed rates, so they've got a little bit of latitude. In Australia, we've still got the bulk of people on variable rates. And it's interesting that the banks have been pushing very hard to get people onto variable rates. ANZ, for example, and CBA have cut their variable rates for new variable rate mortgages at the moment to try and get people onto the variable interest rate escalator, right? Because what they want is protection if rates rise.
Yeah, and well, I mean, you can't blame them. I mean, people have been given the choice, and that's the decision they're making. But I mean, it does make me think that if the Fed does continue to get pressured, I mean, like Joe Biden, for example, came out recently and basically said that that the Fed needs to act more seriously and more quickly on inflation, and that it's basically his number one concern. So if that starts to feed through to the Fed, and then the Fed is forced to hike more aggressively, or even just hint that there's going to be a much, much quicker steepening of interest rates, that could really start putting some really, really interesting pressure on the RBA. I mean, the Kirk seems convinced. I mean, he's basically said he's 100% convinced that there's going to be a 0.15% rate hike in the next few months. And I mean, that would really put the cat amongst the pigeons, both for Scott Morrison at the next election, and also the fact that we haven't had an interest rate rise in basically a decade. People, the psychology just isn't there anymore. I mean, there are people who are, more than almost over halfway through a 20-year mortgage who've never seen rates rise.
Oh, absolutely. And, even a small rate rise is highly symbolic. And the interesting question, as you say, is if they were to raise rates before May, which presumably is when the election will be, that's really going to mark ScoMo's card, isn't it?
It is, because, I mean, during the 2007 election campaign, I actually wrote an article about this. I'll send it to you, Martin. You can post it in the description. In 2007, John Howard, during the Kevin '07, as it became the Kevin '07 election against Kevin Rudd, he had to get on national television and apologize for rates rising because they rose during an election. And that rate rise is about, on my sort of very rough estimates off the RBA's average variable rates over time, that rate rise is about less than half of the impact that borrowers are going to feel now if rates rose by 0.25%. So, it's going to be really interesting, because the problem is that the total proportion of flows into mortgages, it used to be that interest was the larger proportion of the total. But now, as principals have gotten larger and interest rates have gotten lower, the principal is now larger. So if we go back to a time where the interest component is once again, even half or larger of the total amount that people are paying on their mortgage, all of a sudden those mortgages are going to get a whole heap more expensive than they are now.
Absolutely. And, we remind everybody again that the average new mortgage over the last year is somewhere between 10 and 15% bigger than it was a year ago, right? And when people are actually paying very low rates, an incremental rise in the rate you're paying relative to the size of the mortgage means that the pain is significantly bigger.
Indeed, and I should just note that this is actually the last slide for today. So I don't actually need to do anything, do I?
Okay, cool. Well, that slide is a real killer slide. I'm just going to show it full screen once more time. Yeah. Okay, so what I will try and do, I think, is we should make a not for this show, but for another show perhaps, to make an animation of this chart over the last 6 months, right? Because you can remember, as I can, when they were saying, well, there might be a few rate hikes, but not immediately, no, year after year. But this is really accelerated now, so very significant way to end the slideshow.
Yep.
And if you basically put all that together,
yep,
and we talk about what might break, it's worth just exploring that slightly further, right? So clearly, interest rate moves could break things, right? The COVID infections and fallout could break things. We've got an election ahead, and at the moment, Labour's quite well ahead in the polls. So that could be an interesting conundrum. And then you've got Western Australia sort of further declaring UDI and going off. They want to get a large pair of scissors and just cut up the border and just push Western Australia further away. They want their own currency, I'm pretty sure.
Oh, what, the WA yuan?
Well, yeah, it should have something, or maybe they should go back to the gold standard.
I don't know. Well, I mean, wouldn't it be more apt if they just paid for everything with iron ore? Yeah,
exactly right. Yes, iron ore ball bearings as the standard. But it is interesting. There are so many uncertainties, and then if you overlay the consumer difficulty that we touched on, and the small business sector, the number of small businesses in my surveys that were expecting to do well over Christmas and New Year, particularly in the hospitality industry, for example, and hotel and accommodation, and we're expecting some international travel as well. None of that's happened. So a lot of them are really up against it. And the interesting observation there is that the amount of support from government to the small business sector that are actually under pressure is way, way, way down on where it was, a couple of years ago, which means that they've got very little runway left. They've basically used all of the runway they had, and nobody quite knows how long this is going to go on for. So it really does highlight that we are in a situation where there are breakages everywhere, potentially.
Well, absolutely. I mean, you've got the issues with supply chains in China, for example. I mean, I was sent an excerpt of an interesting report from UBS on Twitter that basically showed that the UBS analysts believe that the supply chain issues out of China aren't going to be fixed until 2023. That they're going to remain an issue well throughout this year, and that's the base case. And if Omicron takes off further and you start to see more large-scale lockdowns, particularly in port cities and in manufacturing centers, that could get even more challenging. And then you've obviously got you've also got the geopolitical overlay. Biden is threatening to remove Russia from the SWIFT banking payment system, which may not sound like a big deal, but it's basically just cutting Russia out of the entire global financial system overnight, which would prompt a rather serious response from Moscow. So it's getting pretty interesting out there, to say the least. And I mean, I can say, in this particular instance, you just don't know which way it's going to go. I mean, if you had have asked me, a couple of days ago, would I think that Russia would consider a full-on invasion of the Ukraine? I would have said, well, I think that they might take parts of it, yeah, but they'll probably just pick away at it as they have in the past. But now, with all these comments from Biden, how they're being interpreted around the world and from Moscow, and the fact that there's a massive flow of US and European weapons into Ukraine, the answer now is I don't know. Some people have said that it's a near certainty. I mean, I don't share that viewpoint, but to be completely honest with you, some of these people are smarter than I am.
Well, it is interesting. Of course, Biden had to walk back his earlier comments, right? Because he was sort of almost gave Russia permission to invade a bit.
Yeah, well, exactly, and it really depends on what is a bit. Is it just going further into the Donbass region, or is it pushing all the way up to the Dnieper River, which is basically divides the center of Ukraine, and it cuts right through the center of Kiev. So there's some rather serious questions there, and I mean, to be completely honest with you, I don't realistically, aside from making Russia's life a misery by training the Ukrainians and potential insurgents if Russia does invade and giving them all weapons and everything, I don't realistically think we're going to do anything, because nobody wants to start World War III. We've already had World War II. No one wants to start World War III over the Ukraine, especially not when there's the main event going on across the Taiwan Strait.
No, and it's also just worth understanding the gas situation, right? Because there is this pipeline, right, which is completed from Russia to come into Western Europe, except that Germany is now holding up its certification.
Yep. Have you seen that great chart? I think it's from the S&P research team, the commodity team, and it shows the flows of Russian gas into Europe via whatever the different pipelines. Now, there's Nord Stream 1, which is the existing pipeline, which is roughly tracks the same course as the Nord Stream 2 pipeline, which is the one that's currently in dispute. But then there's all the other pipelines, the ones that run through Ukraine, the ones that run through Poland, and etc. And Nord Stream has been great, perfect, same, very, very strong flows with a few exceptions for maintenance and the usual type of stuff. But the other pipelines, some of them have even gone backwards with gas flowing to Russia, not from Russia. So it's really, really interesting how the Russians are leveraging that. And not only that, but as it gets warmer, as the winter starts to fade, that's when things start to get really interesting. Because, well, as Napoleon and Hitler found out, war in Russia and Ukraine in the winter is not fun.
No. You want to warmer months if you're going to do something. No, it just shows you again the geopolitical tensions, right? And as you say, you've got the main game with Taiwan and China, and then you've got the issues in the Middle East, and then you've got Europe and Russia and dancing around each other. Wherever you look. The trouble is there are so many areas where there are risks of policy missteps, right? And those policy missteps can really trigger something very significant, which would have massive consequences economically as well as geopolitically.
Exactly. I mean, that's why I think, there just needs to be and this obviously isn't financial advice, so, feel free to disregard and do whatever you want. But, you look at some of these things, right? So say hypothetically, Russia does invade Ukraine. That's just, it takes, a good chunk of the Russian speaking eastern half of Ukraine. And Biden is true to his word, and he cuts Russia out of the SWIFT system. That could create just one of the worst issues with commodity prices and oil and gas prices since the fall of the Shah of Iran, if not a worse scenario, which would just send markets to the floor and just could completely undermine just everything. Everything. Like all of a sudden, you filling up your car is going to cost you $3.50 a litre for fuel, or whatever ungodly sum it ends up costing. With, as Putin takes his revenge on the world for being cut out, and there's just all these different scenarios that are possible out there that could basically just undermine things. But it's just funny because not that long ago, even if the Fed flips, they suddenly decide that they're not going to cut interest rates anymore, people would still be bullish. It doesn't matter about all this other stuff.
No, and it's worth just reflecting also, of course, that supply chains are very much driven by the price of fuel oils, right? So, further disruption to supply chains because the cost of fuel goes through the roof, well, that's going to have a really significant impact. The supply chains are already pretty broken, and this could be another factor on top. So keep watching, folks. This could be interesting.
Definitely. And just on the topic of supply chains, one of the interesting things is people are like, oh, but shipping costs are coming down. It's like, yes, but look at shipping costs out of China. That's the big one. It's all well and good to say, oh, but I can ship something from Rotterdam to New York, and it's cheaper. It's like, yes, but the biggest flows of goods are from China to the West, and the Shanghai Containerized Freight Index it just keeps going up.
Absolutely. And by the way, also look at lumber. This is an interesting one, right? Because lumber prices were very high, then they came all the way back. I noticed that they're climbing up again.
Well, I guess it's just about demand, and not only that. On the topic of lumber and the supply issues, the vaccine mandate for truckies in Canada is causing some rather major issues. That there's been some rather serious warnings from experts about that it could create shortages, and particularly because basically American truckers go into Canada, they go and collect the lumber, for example, from Canadian sawmills. But the problem is somewhere between 50 and 60% of, depending on the estimate that you get from the various different unions, about 50% of American truckers are unvaccinated. So they're not allowed to go into Canada to collect the goods. So there's all these different problems that are going on behind the scenes, but you don't really find out until the shelves are empty.
No, absolutely. Well, my analogy for the economy is it's a Rubik's Cube, right? And you keep sort of twiddling the pieces to try and make it all fit, but it's blooming hard to do, right? I wonder whether it's feasible now, or have we actually created a global machine that's just too complicated to manage? And are we in a situation where we're never going to get back to normality, whatever normal is, right? Or we're always going to have these huge forces which are, financial, geopolitical, and everything else too. And if that's the case, what does that mean for the global economy as well as for people in their own countries? And I don't know whether this then leads to another surge of nationalism, another surge of Trumpism, for example, in the US, because Biden's popularity is it's a lot lower than it would have expected to be at this time. I was looking at the other day, and it was several points lower than on average after 1 year. He's been there a year, of course. It just begs some interesting political questions in local economies around the world, and particularly, I think, the US.
Well, agreed. Biden's approval rating is worse than any other president since World War II, with the exception of Trump, and that's to be expected considering the division that his presidency resulted in. Just inherent from day one, people didn't like him, and that's just the way it is. But one of the things I think is just interesting, and this all goes back to what we were talking about, probably around about 18 months ago, when we just said that that this decade is looking like a rerun of the 1930s, and unfortunately, it's not something that we wanted to be right about, but unfortunately, it increasingly appears that we are. And regardless of what happens, that there are going to be those challenges, whether the challenges are inflation or whether the challenges are a slowing global economy as a result of demographics and the giant stimulus hangover.
Yeah, and that demographics point is really quite important, right? Because more and more economies are getting older and older, and the birth rate is falling, and that means that effectively you've got less working people to support a greater proportion of people who are no longer working. And I make the point that a lot of those people may have had a chance to save, but if savings get crushed because of economic, slowdown and the fact that maybe the financial system wobbles further, there's a huge knock-on effect, which I think is being underestimated. And I actually think of all the things that are going on, those big demographic shifts and the risks in the system are probably worth reflecting on. And we haven't even started on climate change, which of course is still there in the background as well.
Indeed, and then there's also the pension crisis. I mean, the idea that, say for example in the US, the core expectation at the viability of the US pension fund system is that they can achieve returns of over 7% per annum, which with bond yields, with say 10-year bond yields at sub 2%, it just isn't going to happen. Particularly given that a lot of these funds have their hands tied and they have to have a certain percentage in investment grade fixed income, which basically means bonds that are either from the government or very, very highly rated companies. So, it's eventually there is going to be that crisis, and it is going to happen. I mean, I guess in some ways that we this recent run up in asset prices has given us a little bit of a respite from that, because people have been able to retire under their own steam, at least in the US. Here in Australia, that hasn't really happened.
No, that's true. And it's interesting that Jeremy Grantham made the point that, generally you do 60% shares, 40% bonds, right? And that would see you through. He said, no, don't, you can't do that. If this is playing out the way that he sees it, that's the last thing you want. He says, well, you go to cash and, perhaps borrow a bit ready to come into the market later and look at commodities. The point there is there are so many uncertainties and so many, ifs and buts and ands that something's going to break. The problem is we just don't know which bit's going to break first.
Exactly. I mean, I assume that we both share the view that eventually the Fed is going to be, if inflation remains strong, that the Fed is going to be forced to stomp on it. That they are going to have to aggressively raise interest rates because politically it will be unviable not to do so. But then there's also the question of, what if we're wrong? What if the Biden administration are just completely miss the point? What if, they just go, okay, we're going to lose the election anyway, but, let's at least keep the fundraising base intact and let's not piss off Wall Street. And they decide that instead. I mean, that I don't think that's going to happen, but let's just say hypothetically that it does. And they decide instead to support the market. I mean, something's going to break there. You are going to see something else entirely break rather than the market. So, it's going to be a hell of a year, one way or another. It's going to be really fascinating to watch. Well,
that's right. And I'll make one last point. That the Fed reported their provisional results for the last year just last weekend, right? It was quite interesting because they basically handed a huge amount of the profit from the Fed activities back to the government, right? Which is what they're have to do. But they also paid a dividend to all their Fed members. Right. In other words, all the Federal Reserves across the US, right? And of course, the holders of those Fed posts, which are, of course, the major financial institutions. So it's worth just remembering exactly right that the Fed is actually paying dividends to the big guys, right, to the big financial institutions. And it's just worth asking the question, so who is the Fed really working for?
Yeah, well, exactly. I mean, the Fed is the Fed by its very nature is run for the financial system. It's run for the by and for the banking system, which is, well, it's really something. I mean, I guess we should be thankful that there is political pressure on them, because otherwise the gravy train would never stop.
Well, that's right. But it is interesting that it's cloudy and the relationships are cloudy. But sometimes you just stand back and think, well, hang on a moment, who are these people actually working for, right? Because the net effect of what they've done over the last decade is to blow up the economy with massive amounts of debt, massive amounts of stimulus. We've seen all the effects of that. The overall activity in the economy is still very low. And now there are significant risks either on the inflationary side, or if they don't put up interest rates, and just flood the economy with yet more stuff to support the financial system. This could go on and on and on. And I don't know which of those two scenarios is most likely, because at the moment they both seem to me to be perfectly valid.
Yeah, well, exactly. I mean, I don't even know if they're going to have time to decide with all this stock buying that they keep doing behind the scenes.
Well, that's right. And of course, they are still quantitatively easing yet more. They're still bond buying at the moment.
Well, that's what's so interesting about this recent drawdown in US stocks. It doesn't even take a taper anymore. Like a full on. We're going to reduce the spend on asset purchases down to nothing. It's just the threat of that happening, and all of a sudden, you see the Russell 2000 heading for the cusp of a bear market. I mean, I think that the next few days are going to be interesting, because we've got the options expiring later tonight. In the US, you're going to see $3.3 trillion worth of options expire in the next 24 hours, and that has coincided with the bottom. Those days have been down days, and that have been the bottom of US stocks recently. So if next week they do continue their downward trend, that could be a very, very interesting signal.
Yeah, buckle up, folks. This is going to be a really interesting ride, and you can place your bets on which bit's going to break first, because we've no idea, but we'll keep watching and we'll keep chatting about it, eh, Tarric?
Yeah, sounds good, mate. That's we really do have no idea.
Well, at least we admit it.
Yeah, well, exactly. Honesty is the best policy.
Exactly. Thanks for your time, as always, and we'll do it again soon.
No worries, mate. Happy to do it.
Thank you.
Bye,
Bye-bye. Bye.